This is TreppWire Week in Review for week ending April 1st, 2022. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Henry, Head of CRE and Advisory Services. And joining us today is our own Matt Anderson, Managing Director here at Trepp. This week, the U.S. will release up to 180 million barrels of oil from strategic reserves and a flurry of data as we close and assess the quarter. Private payrolls grew more than expected this month, with leisure and hospitality leading the gains. Average home prices rose 19% year over year in January. The Fed's favorite inflation gauge, PCE, rose 0.6%, the biggest monthly gain since 2008. Manus, the Treasury note yield curve inverted briefly this week, which historically has indicated a recession. Is that the case this time?
Well, there's a lot to digest over the last week, and fortunately we have our resident expert from Trepp, Matt Anderson, on today to help us hash it all out. Matt is a person at the firm who looks at a lot of macroeconomic data. He's been studying the tea leaves and the data for decades, and hopefully he'll be able to fill in a lot of blanks that I have not been able to fill in for the last couple of weeks. It was generally a positive week. We saw stocks rally for the most part. The rally kind of petered out the last couple of days, but by and large, equities really closed out the quarter on a positive note. It remains to be seen whether or not this is a bear market rally or the start of something bigger and better. We saw Treasury yields come down from their peak of about a week ago. I think the 10-year is now down about 20 basis points from where it was about a week ago. That's a positive development. We'll talk a little bit more about the CMBS market later, but there was some momentum there that felt pretty good. The ADP jobs number that you referred to came in higher than expected. And, I think on Friday morning, a lot of the headlines will talk about how the Fed's favored measure of inflation hit a 40-year high, which is true, but it really came in line or slightly below expectations, which is a positive sign too, which perhaps inflation has stopped getting away from us all, or at least kind of lapping our expectations. So by and large, other than the fact that we had a false start in the Ukraine where it looked like tensions were starting to come off the boil a little bit, that seemed to be a false start, and ceasefire rumors turned out not to be true. Other than that, it was a decent week for the market.
Yeah, there's a few other stories here, market-related, Manus. I think Martha hit on, releasing of oil from the Strategic Petroleum Reserve. Just to give some context to that, what they're proposing is up to 1 million barrels of oil per day, which would represent the largest release of Strategic Petroleum Reserve since it was established in the early 70s. And just to look at production, March 2020 levels were about 13 million barrels per day, and currently we're at about 11.6 million barrels. So even if they release 1 million barrels per day, we're still not to where production was in 2020. When consumers were using a lot less oil, people were driving a lot less, gas consumption was significantly down. So I think there's more to come on this. We heard and talked about the gas tax relief bills that several states had either contemplated or passed over the last few weeks. So I think this is a story to keep watching. I was watching some news this morning, and I think the oil prices had actually come down slightly. So it's very volatile relative to what we've seen the last couple of weeks. S&P CoreLogic Case-Shiller, their home price index, which measures the average home prices in major U.S. metros, rose 19.2% year ending in January, compared to 18.9% annual growth in the previous month. The interesting takeaway here, and tie into the CRE and kind of just real estate marketplaces, the inventory of homes for sale at the end of January was the lowest level on record since the National Association of Realtors began tracking this in 1999. So as stocks are kind of, up and down, oil is up and down, the one thing that from an economic perspective that has seemed to remain constant is a supply and demand imbalance with housing and continued increase on the housing cost price front.
We do have a couple of headwinds and tailwinds in that part of the market. For valuations, the tailwind is the fact that there is very low inventory out there, right, which will keep a floor under prices. The headwind, of course, is it now costs more to own a house with interest rates up. I think that the average interest rate now is about 4.75. I think it was probably mid threes or less for a long part of last year. And then, of course, the cost of owning a house when you factor in commodities and so forth is also up. So we'll have to see. That Case-Shiller number is a January number. They usually put it out 60 days after, so that price increase that we saw didn't reflect anything having to do with Ukraine, higher interest rates, or higher commodity costs. So I think the big number there will come out more in the spring, and we'll have to see if any of these numbers have taken a little bit of the air out of the balloon, so to speak, in the housing market. You always have to talk about these things on either side of the coin, right? If you're a homeowner, right, this lack of inventory is a great thing, because if you're a seller, you really have that floor under your house. But if you're a new home buyer, if you're 30 years old and starting a family and trying to purchase your first home, it's problematic, right? The stock is so limited, and it seems like there's 10 buyers for every home out there. That I sympathize with those that are in that situation.
Manus, early in our discussion, you mentioned some green shoots in CMBS. What were those?
Well, we're going to talk about delinquencies in a little bit, but the most immediate one is we've now seen 3 deals price, 3 conduit deals. 5 deals have kind of been put into the sausage maker, announced, preliminary prospectus, put out data, information, tapes, et cetera, for people to analyze what the credits look like. 3 of those deals have now priced. And the interesting metric there is that not only have deals come to market and priced, but the damage, if you will, in terms of wider spread, has been less than perhaps I would have anticipated, given the volatility we've seen in the market. So 2 of the deals that priced came from what is called a shelf. I'll give a quick background here. A shelf means it's an issue from the same issuer that tends to issue over and over and over again during the course of the year. So, for example, JP Morgan will set up a shelf, for example, for all of their CMBS issuance. And every time they issue a new deal, there's a prospectus supplement and they come out with a new deal. So, years ago, they might have had series C1 and then C2 and then C3. So a metric for us is to look how deals of similar shelves have priced from one deal to the next. So in this particular case, 2 of the deals that priced in the last couple of weeks also had deals that priced in early February. So you can make a comparison here and say, how much wider was issuer A's deal in March versus where it priced the last deal in February? Hopefully that makes sense, but it gives you a sense of issuer to issuer pricing, right? Because each issuer has a different niche in the market, sometimes it's not fair to compare a deal from JP Morgan to Morgan Stanley or Morgan Stanley to Goldman Sachs. They each have different niches in the market, but this does help when you have Morgan Stanley to Morgan Stanley or Wells Fargo to Wells Fargo. So we had 2 of these, and in each case, the long AAA bond, the 10-year AAA, priced at about 22 basis points wider in March than where it priced its last deal before the Ukraine war. And if any of this doesn't make sense, please reach out to me and I'll communicate with you via email. I think this is a little bit dense. If you look at kind of the single A and triple B segments of the market, they were more like 50 to 55 wider, which again, wasn't nearly as bad as I would have expected. I think about 2 weeks ago, Lonnie and I were talking about triple A's being 25 to 35 wider and triple B minuses being 75 to 100. When the rubber hit the road and it came time to price these deals, it wasn't nearly that wide. And it's a sign that the markets are functioning and there's still demand for CMBS conduit paper. So a little bit of a green shoot there.
Manus, do you think these things are a byproduct of a longstanding sense of relative uncertainty? So what I mean by that is we've had so many things happen with COVID, Ukraine war, like all of these things that what used to have been perceived as significant risk at this point on a relative basis is just considered par for the course. I mean, we see this on the CRE side with, relative affordability. If you're an office owner in New York or San Francisco, you're willing to go to a secondary market that has upside potential and pay what seems like an outlandish price there. but on a relative basis, you're still, buying something significantly less than you could in your local market. And I think on these, like if we were to do a blind poll and say, you're going to have 2-year pandemic, you're going to have, a war that could potentially be World War III, like on the face, each of those would probably incite significantly more risk. But it seems like the market has kind of priced these things in, not just in CMBS, but generally as almost like standard operating procedure at this point. Do you think that's part of this, or do you think there's still more to come on maybe some deals that come out over the next 30, 60, 90 days?
Well, that's a loaded question. I think there's a lot of ways you can take that. I, for one, have been shocked that the markets have remained so orderly. Yes, we've seen widening, but it hasn't slowed down lending to any significant degree. We've seen a drop in prices in the CLO corporate side, the leveraged loan asset size. That has forced a tapping of the brakes of the CLO market, but we haven't seen kind of disorder like we saw in 2008, like a real slamming of the brakes. And we haven't seen it like we did see in 2015, 16 with the oil crisis and so forth. For people that are even older than that, there was a complete slamming of the brakes in the early 90s when we saw the recession and the commercial real estate collapse and so forth. So I'm shocked that there has been as much complacency as there has been. And normally there's 2 levels of worry. First worry is when you start to see credit events and you start to see concerns about prices and volatility and things like that. That is something that people tend to get their arms around and can adjust for. Where things seem to start to go off the rails is when people start to say, somebody's going to blow up, right? We talked about the big whale in London, right, 10 years ago or so. We talked about AIG and Lehman Brothers and Bear Stearns during the great financial crisis. We talk about long-term capital. When people start looking at each other and saying, I don't know if that guy's creditworthy anymore, that's when things slam on the brakes. And I guess the reason I'm so surprised by the complacency is we've seen some cracks, right? We've seen the nickel market have to shut down. We've seen a margin call in the oil markets with Peabody Energy. I'm surprised there's as much complacency as there is, and not as much suspicion as there's a looming blow up of somebody on the wrong side of the trade. That may still happen, but thus far, I don't know if it's like a run on Xanax or, just a lot of runs to the liquor store. I don't know what it is, but people seem to be dealing with this crisis with a more level of calm than I would have expected.
So at the outset of our discussion, we mentioned how the yield curve was briefly inverted. Matt, I got to ask you, you're the expert on this type of topic. Is the curve really inverted?
Excellent question. And I'm not sure if anybody quite qualifies as an expert on when it comes to interest rates, because they really can move around so much. I would say at the moment, they're not quite inverted, but they're awfully close. And when you look at, we took a look at a history on the spread between the 2-year and the 10-year. Again, it's not quite inverted yet, but it's really close. And it actually has been a pretty reliable indicator of both future recessions and then, of course, stress for commercial real estate in the past. So, when we've had that spread either approaching zero or certainly going positive, where the 2-year yield is higher than the 10-year, that has been an indicator of a subsequent recession reliably for the last 20, 30 years.
So let me jump in for a second here, Matt. I have a ton of questions for you, but I just wanted to give people a little bit more background on what Matt has done for us. After the great financial crisis, we spent a lot of time with US banks, helping them build credit default models, both from the top down and the bottom up. The bottom up models that Matt built use a dozen or so macroeconomic variables like GDP and unemployment and interest rates and so forth to predict how commercial real estate loans will perform under various stress scenarios. That has been used by major US banks to help meet the Dodd-Frank and CRE mandates. He also built a top-down model which allows us to predict which banks will see stress hitting their equity levels due to various losses and so forth. So he's been studying this stuff for a long time, and he's also our go-to guy whenever we have to bring in expert commentary to the Federal Reserve or Congress or so forth. So he's my go-to guy whenever I have questions like this. And I'm going to ask these as somebody who really is a novice on these, but let me start with this one, Matt. So the question is that the Fed has signaled up to 3 percentage points of rate increases or close to it over the next couple of years, right? We were basically at zero. They said by 2023, we could be up to a terminal rate of 275. Historically, what has that done to commercial real estate values when we've seen a big spike in interest rates over a short period of time?
Well, over a short period of time, of course, the impacts, and with a large movement, the impacts would be negative because you have borrowing costs going up rapidly and cap rates that people use to establish values in the commercial real estate market. Those go up precipitously as well when rates go up. The surprising thing to me, though, is we took a really long-term view. We grabbed as much data as we could going back to the 50s, and we looked at how changes in the Fed funds rate. So you mentioned that that is what the Fed controls explicitly, and they're talking about raising those rates up to 300 basis points over the next year. We did take a look at how shifts in the Fed funds rate then related to commercial real estate prices over the next time period. So we looked at 1 year, 2 year, 5 year time horizons. And the thing that surprised me is that at least in nominal terms, decent sized rate hikes actually still correlate with positive longer term growth for commercial real estate. And once we thought about it, we realized, well, that's because the income component is rising along with inflation. So the drivers behind those rate increases, it's hard to, in economics, you want to like tear everything apart and isolate impacts. It's hard to do when there's inflation and interest rates intertwined so much. What's going on for commercial real estate, at least longer term, is that the inflation that's driving those interest rate hikes is also driving rental growth. So the income component that drives both current income and the ability to pay mortgages, and then longer term that establishes the cash flows that are being discounted into the future, those are growing. And so those, historically, those have been large enough to offset the increases in cap rates. So as you mentioned, definitely a short-term dislocation. A lot of concern about, for anyone that's got a deal out there at the moment, that can be worrisome if they haven't secured financing yet, or haven't closed on a deal. If interest rates spike and cap rates go up, you can see some deals potentially falling apart. But longer term, the news isn't all bad, and that's all in nominal terms. In real terms, however, not surprisingly, inflation is a bad thing because that erodes the future value of those current dollars. So in real terms, there ends up being a sweet spot for commercial real estate. And that sweet spot is basically where we've been for the last several years, with flat to declining interest rates. That, of course, is associated with low inflation. And so then you get the benefit of cheap financing and actual growth in the market itself and the underlying values.
So one thing that I've seen quoted a couple of times in Barron's and in other publications as well is that, the long bond is really being distorted lower. That the fact that the Fed has been buying securities by the hundreds of billions really for 24 months has really kept the long end of the curve artificially below where it should be. In fact, there was a quote this week, and I wish I could remember who said it. They were saying that if you take the thumb off the scale by the Fed of buying these securities, the 10-year is more appropriately at 375 under those circumstances. So given that, are we inverted, or were we inverted last week, or not? Should we not look at this as a recession indicator at this point? Give us your thoughts.
Yeah, that's a good point. Quite possible that, the Fed's involvement in the markets has definitely driven those long rates down. The Fed balance sheet is about twice what it was pre-pandemic. So now it's at about 9 trillion. and it was 4.5 trillion before the pandemic hit. So obviously the Fed has been out there, actively supporting the market, both through lower interest rates, but then also at the long end through all their bond buying. That 100 basis point figure, that might even be a conservative one. I had seen some research done a long time ago when the Fed balance sheet was quite a bit smaller that indicated a 100 basis point impact on those long rates. The balance sheet has grown that much more since then. So it could be even more than 100 basis points.
So let me throw one more question at you, Matt. I know you have your own indicators for market euphoria. We talked about this in our prep call yesterday a little bit. Back in 2007, we were seeing properties trade in 2007 for 40% more than where they traded in 2005. It was an incredibly euphoric period, and we saw that didn't end well, that properties were really overvalued. Underwriting had been extremely lax, and losses followed. We saw a story this week in Norcross, GA, an apartment complex that traded at about 5x where it was in 2013. I think it was Peachtree Corners. And Lonnie and I have talked about a lot of these things over the last month, things trading for 2x and 3x of where they were 2 or 3 years ago. What are your tea leaves telling us right now? Are we in a incredibly euphoric period, and is the house of cards going to come down, or is it different this time?
Yeah, you mentioned our default model. One of the measures that we use, it's an input into the default model, is market liquidity. And so we've used data on capital flows from the Fed, and we've created our own liquidity score that we scale from 0 to 10. That liquidity score is expressed in real terms. So we do take both the, just dollar growth of the market into consideration, but then we also factor in inflation. So in times of exuberance, that liquidity score has gone really high, and it scales up to 10. Our scale is from 0 to 10. So in 2007, 6 and 7, leading into the great financial crisis, that was in the 8+ range at that point, because the market really was growing so rapidly, even in real terms. When the market collapsed, that liquidity went down to 0 or nearly 0 during the financial crisis. You mentioned the early 90s cycle, a similar sort of pattern back then. Pre-crisis, the growth rate was in the 9 to 10 range on our scale. And then when the crisis hit in the early 90s and liquidity dropped to 0, that's the measure that we look at and that we use as an indicator in the default model. Right now, those measures are in the sort of 3 to 4 range. So when you factor in inflation, that rapid growth, in some cases double-digit growth, like for CMBS last year, it really isn't quite as high as it looks.
So Lonnie, how do you feel about that? What does your gut tell you down in Texas? Does it feel like we're in a 3 or a 4 on the euphoric scale, or does it feel hotter? It feels hotter than that for me, but the numbers don't lie.
Yeah, I think so. Do you guys ever read anything, any of our listeners read anything that we put out from a research perspective that says underlying fundamentals in the text of the narrative? You'll know that I wrote it, because I'm a believer in the underlying fundamentals. And I think logic tells me that we're a lot higher than a 3 or 4. I mean, you can't have the type of price increases that we've had across all asset classes, pretty much across all major markets, secondary and tertiary markets, without there being an influx of available capital, without there being people taking risks and buying assets in places that they otherwise wouldn't. Like, the chase for yield is real. And we're seeing that when you have an entire contingent of people on Twitter that have started a self-storage, army out there, and they're buying up, 40-unit self-storage properties on a 4 cap, thinking that they got a really great deal somewhere. I believe in Matt, and I believe in the forecast, so I'll trust the numbers. But my little brain, Lonnie, logic says, I think the market is probably still overinflated. I think, a couple of things. So one, I'm clearly not an economist. Interest rates and yield curves are not my specialty. In fact, when I hear the yield curve is inverted, I revert back to Top Gun when Maverick and Goose are telling the flight instructor about their foreign relations with the Russian MiG, and she says, "How do you know?" And he says, "Because I was inverted." So that's what takes me back to that. But in a serious note, Matt put together a really nice research piece. So for anyone listening that's interested in this in a little more granular detail, beyond just what we've talked about today, we put out a research piece today that you should be able to find on LinkedIn. We can certainly email it to you if you send us a request, but it goes through and gives a really nice breakdown of all the stuff we've talked about today. I think it looks at data from 1954 through the fourth quarter of 21 and just tries to make sense of this from a macro perspective, and then looks at some of the more granular topics we've covered today. Just as a simpleton CRE guy, if you compare this to the great financial crisis, a lot of the financing there were not fixed rate, and a lot of them, the defaults were residential in nature, and that had a lot to do with RMBS. This does seem a little bit different. The underwriting seems to be more stringent. My one question there would just be that these properties that have seen real rent growth of, double digits for the last 4 years, while that's not pro forma underwriting because the market's, borne that out, is that really sustainable into the long term? And that's the part where I have a little bit of question.
Okay, turning to our preliminary look at CMBS delinquencies, where are we at for the month, Manus?
Yes, we'll put out our final numbers early next week, but and a hat tip to Max Nelson, our crack data analyst, who gives us our preliminary numbers to talk about every month. We should see another modest decline this month. Listeners may recall that we cracked the 4% overall delinquency rate recently. We should show somewhere between 10 and 20 basis points of additional decline. I think the most noteworthy thing we're seeing right now is a further reduction in the percentage of loans with a workout specialist, with a special servicer. So there we're looking to crack 6%, it appears. That number was well into the double digits at the peak of the COVID-19 pandemic. I think we're at somewhere between 12 and 14%. So we're less than half of that now. On the delinquency side, going back to that, we did tap out at about 10.3% in June of 2020. Now we're under 4%. We just keep squeezing the distress out of the system, and it's a great thing to see. Hopefully, we do see a big wave of maturing loans in the rest of 2022 and 2023, that doesn't stop the momentum that combined with the higher interest rates. But it's been a good story that has been going on for the last 20 months or so.
Yeah, if you look at the property types, lodging saw the greatest decrease from February of 22 to March. It looks like the preliminary numbers for this month, lodging delinquency is about 6.85% as compared to 7.84% in February. So about a 1% change to the good. And it's interesting to see retail was almost unchanged, still at about 7.46% in March compared to 7.49 in February. So those two have been the laggards. Lodging seems to be coming back. I think we've had, significant discussions around that sector holistically, coming back. It's good to see the delinquency starting to decline there, getting a little bit closer to historical norms. And I think retail, it'll be interesting to see if that's kind of the new norm, if maybe it's a 5 to 7% type of number for the foreseeable future.
We have two thoughts there. Number one, on the lodging side, we're now at almost 1/4 of where we were at the peak. So, we're going to be under 7%, it appears, when the final numbers are done. And we were above 25% at the worst part of the pandemic. So, not quite 1/4, but getting there. On the retail side, the thing that may keep those numbers kind of higher level than we've seen in the past is just those mall loans that have size and that just kind of remain out there in CMBS purgatory, right? That they remain past their balloon date, can't get refinanced, and it just takes time for those to squeeze out of the system, or for a sale to take place or a modification to be negotiated. So that may level off at levels that, are higher than we've seen in the past 15 or 20 years.
So sticking with lodging, a couple quick stories as we shift into a couple property sector details. Business travel volumes were up significantly in the last 9 weeks. And according to SAP Concur, if you wonder who they are, they're the expense reporting platform, as many of you know. So they ought to know. More people obviously are filing expenses for travel. A lot of that is due to small and medium domestic travel and a resumption of conferences. And those of us who are on the conference circuit know very well that conferences are back in force. So it'll be interesting. I don't know what you guys think, but with the rising prices of fuel, pricing of rooms, rental cars, that may deter some corporate travel, but it's nice to see that the drive to get back out there is there.
Yeah, I've been in an airport about 8 of the last 10 weeks, and I can tell you business travel is back. In fact, I've had multiple flights canceled. Every flight I'm on is overbooked. There's a list of 10 or 15 people on standby just trying to get on the plane. So, I think we're actually seeing, the resurgence of the business traveler now. As it pertains to some of these large luxury resort style hotels, I don't really have any insight into that. But as you mentioned, Martha, the conference scene is back in full force. And, it's really good. It feels good to be back amongst our peers, talking about issues, being on the road and getting business done. And so hopefully this is, the new normal goes back a little bit to the old normal. But rental cars are an issue. Uber is an issue. Those things have not gone down in price. As soon as you land and you open up the Uber app, sometimes it's shocking that the Uber ride can be, 60% of your airfare ticket just to get from the airport to the hotel.
Lonnie and Matt, both world travelers. A little up close and personal about Lonnie is that, when he's not traveling for business, he still likes going to the airport to use that Barca lounger there where you put in, your coins and you get your back massaged while you're waiting for your next airport. He does that just for relaxation.
I've actually, they've added these CPR training things in the airport. So I'm now a CPR expert thanks to the local airport.
So a couple stories, Manus, that take us to Miami and then up to Boston.
Yes, we had a couple of green shoots here in the Boston area. We saw a big hotel sale. The Marriott Boston Quincy sold for $88 million. That's a 464 room property. Sold for almost $190,000 per room, acquired by Paceline Equity Investors, sold by Black Pearl Capital. The story comes from Commercial Observer. It's one of those things I actually thought perhaps Paceline Equity got a steal there, that $190,000 per key level, not exuberant in my opinion, when you consider that the Boston office market has really performed extraordinarily well compared to everything else. That life science corridor has been spectacular, and that may turn out to be a very nice acquisition for Paceline down the road. A nice story for CMBS. The Grand Beach Hotel loan has flipped to full payoff. For those that don't follow the CMBS market all that closely, when a loan is in special servicing, the special servicer, the workout specialist, has a workout strategy code which reflects what they believe will be the final outcome for the loan. Sometimes it's modification, sometimes it's foreclosure, sometimes note sale. For those looking to mine data for opportunities for workout distressed opportunities or note sales, this is not a bad place to look. In this particular case, for this $109 million loan, that code flipped to the expectation being a full payoff. The note had been 90 days plus delinquent for several months over the second half of 2021. Since then, the borrower has brought the loan current and paid back all deferred P&I amounts. That repayment has come even though the hotel has struggled in 2021. DSCR was well under 1.0x in 2020 when occupancy was 34%. Those numbers remained at 0.64x and 40% occupancy respectively for partial year 2021, but that did not keep the borrower from making the loan current. The note represents almost 20% of the collateral behind a 2013 CMBS deal, and the note is expected to go back to the master servicer soon. So a really positive story for both that deal and for the hotel market. So we like those green shoot stories that we could put out there.
And turning to office, according to CBRE, the office market recorded the first positive net absorption since the start of the pandemic. So clearly an interesting development. We got a shout out on Twitter from BB Dogged Tenacity, who tagged us on a story of an earnings call of furniture maker Steelcase, which is based in Michigan. And if you kind of look at the details of their call, it was definitely on the more positive side on balance.
Yeah, this is an interesting story. I know we've talked a lot about the office market related to the Castle Systems, updated weekly tracker in terms of tenant occupancy. This kind of takes a little bit of a different view, but it's very adjacent. So CEO Sarah Armbruster in the earnings call was talking about their furniture maker and their fourth quarter orders, which were up 27% across all segments. So effectively, these are the folks supplying office furniture for office tenants. They were up 27% fourth quarter orders. They have some challenges, however, with taking those orders and turning them into deliveries due to supply chain constraints and shipment delays and so forth. But I think it was interesting because she referenced a Harvard Business Review story that talked about a survey detailing projected impact of hybrid work. So we've talked at length here on this podcast about 3-2 work schedules or even lesser in-office requirements, et cetera. But the results from the survey show that there's not really going to be a need for downsizing in the office, because just because people are coming in less, it doesn't mean less people are coming in. So you may have peak representation across your employee stack on Tuesday, Wednesday, and Thursday. So you still need to have the same capacity requirements to absorb everyone coming in for those 3 days. So the moral of the story here was that across all of the respondents, the estimated decrease in office space was about 1%, which I'm not very good at math, but if we're within a 1% range, I would say that that's probably a zero change in real life. So kind of an adjacent story here. Furniture maker, sales are up. Expectations are that office shrinkage is going to be, nominal, if any. And I think this bodes well for the office market. We didn't really hit on it in the delinquency piece, Manus, but office delinquencies in March are at 1.65. So even though we've talked about the office market potentially suffering, we haven't really seen that in practice. And, from somebody that sells into that space, they seem pretty bullish and their sales would support that.
So I have a couple of green shoots. Before I get there, I want to go back to Matt for a second. I know that you both look at data that is not CMBS data. You look at balance sheet data for banks as part of our taller stuff. And I know that every couple of years you update our models for, look ahead and so forth. So let me give you a two-part question. What has the office delinquency rate and loans under concern look like at the banking portfolio? And what do you think about this 3-2 work schedule, and how will it have you look at the data differently going forward? Give us your skinny on, from a modeler's perspective, what are you looking at?
Good questions. With regards to the bank data that we have, so this would be granular detail at the loan level on CRE loans that are on bank balance sheets. So a parallel data set to the securitized world, but obviously a bit different. Office delinquencies have gone up a little bit, pretty steadily through the COVID impacts and beyond. We're still crunching numbers for the fourth quarter that just came in, but it looks like the office delinquency rate there actually edged up very slightly. So it's still a little bit elevated. Having said that, it's not really that high. It's at about 1.5%, which is above, the pre-pandemic levels were virtually zero. It was in the 0.5% range. So, definitely delinquencies have gone up. More noteworthy than that maybe is that part of the data set includes risk ratings that the banks assess on their entire portfolio. So that would be somewhat like the watch list and the special servicer list for the CMBS world, watch list maybe in particular. And what we've tracked there is what we call criticized loans. So those would be loans with a higher risk rating. So the bank is expressing concern about the loan. Doesn't mean that the loan is actually, in deep water yet. It just means that the bank has concerns either, specifically about the property or the borrower, or in this case, what's more likely is the market. Not surprisingly, the criticized loan rate is in the sort of 60% range right now. So basically, the bulk of your bank loans to hotels are of concern. That's actually down a little bit from the peak of 70-80%, through COVID. But then in the office sector, it really depends on the region. Overall, that rate has gone up, maybe surprisingly, in the mid-Atlantic region, which would be heavily weighted to New York. Office loans are at about 30% right now or so. So that means that, by the loan balance, 30% of bank office loans in the Northeast are on the watch list.
I think we have our headline, Haley, for this week. I think that's not something I saw coming. I thought that, we
That's
have.
called bearing the lead.
There we go. We have, in the CMBS market, low single digit delinquencies and not a tremendous amount of concern at this point. Low single digit delinquencies on the bank portfolios, but a fairly high number of loans being watched by portfolio lenders. That's something I didn't see coming, and that'll be interesting to watch in the coming months. I do have a couple of green shoots. That was kind of a crabgrassy line there, something, like I said, I didn't see coming, but I'll start with Chicago. In Chicago, we have news of a sale, and this comes from Crane's Danny Ecker late yesterday. He reported that Tim Callahan and others had made a purchase of 110 North Wacker, not for the whole thing, but for controlling interest. But the portion that they are buying values the asset for north of $1 billion. This is an extraordinary valuation for that part of Chicago. 110 North Wacker is a 1.5 million square foot tower with Bank of America as the fairly recently announced new tenant there in the last 2 years. Another green shoot we probably should have mentioned this last week, Blackstone on the hunt for new headquarters in Manhattan. They're looking for 1.5 million square feet in the Big Apple. Why did that get my attention? Well, with the work from home stuff, you're not sure how much space any of these big operators are going to be looking for. Are they going to be looking to downsize, or even worse, get up and move to South Florida or somewhere else, Tampa, Jacksonville? In this case, Blackstone making the big vote of confidence for the Big Apple as they look for 1.5 million square feet. Two others that I have, one in Boston, love this one, 55 Summer Street, acquired for $107 million. Phase 3 Real Estate Partners was the buyer. They have been active in creating lab space. The price equates to $850 per square foot, but you have to assume that $850 a square foot is the starting point, that they're going to pump a lot of money into this to convert it to lab space. The property last sold for $48 million in 2014, so 122% gain over the last 7 years. That story was from Greg Ryan of the Boston Business Journal.
Yeah, Manis, it's good to see, that transaction take place, and you kind of hit the nail on the head there in terms of the 850 being representative of the going in cost, because that life science lab space in Boston has really taken off. And so this is almost like the data center space a few years ago, where you see buildings trade and then they put an enormous amount of tenant improvements into the building to finish them out to their specifications. So I would expect to see that here in the Boston market to continue to grow. It's one of the most vibrant in the U.S., and it's good to see these sales continue to take place. I would just say for our listeners out there, I know over the last couple of weeks we've covered a lot of transactions, and we've talked a lot about sales prices and the most recent sale of the property and how that compared to the previous sale. Just to put a little bit of a product plug out there, we actually track sales data in our CRE Direct database, and this data can be accessed by subscribers. So if you have interest in getting some context around, some of these marketplaces and what is the normal sales price, what are the record prices, and what's the percent change look like, those are things that Trepp studies, on a daily basis. So certainly can help point you in the direction there. And then we can actually, as Matt mentioned earlier, tie it back to income growth and other things as it pertains to individual property performance. So just take a little second there to give a little plug as it pertains to sales transaction, rental rate data, et cetera, that we could surface at.
Turning to shout outs. First one is for a colleague of ours, Brian Bailey at the Fed.
Yeah, I'm going to take us out on this one, Martha. So Brian Bailey, friend of the show, friend of us here on the show, and he actually sent over some stuff for us to look at this week. Governor Waller had a speech that talked about the outlook for housing, and just to give a little snippet of the article or the speech, house prices are up a cumulative 35% since the beginning of the pandemic. So that's 35%. According to Zillow Home Value Index, the rate of increase is much faster than the previous 5 years and even faster than during the housing boom of the mid 2000s. So just to give some perspective, I mean, we're saying it's growing more rapidly than that, euphoric time that Manis and Matt talked about earlier, heading into 2007. Looking over the past 2 years, you'd think the large increases in home prices would have made it more difficult for renters to become first-time home buyers. But we haven't really seen evidence of that. The fraction of renters aged 20 to 45 who transitioned into home ownership in the last year was actually highest since the Great Recession. So, it's interesting. I think the more we talk about these things and the more research we do on them, we get conflicting stories every week, depending on which side of the table you're sitting at. So in some markets, first-time home buyers have definitely been priced out. This story from Brian actually says the opposite, that there's actually been an increase in people going from renter to homeowner. So Brian and I are going to be on a panel together at the Ares conference in Florida this next week. So if you're super nerdy and love talking about data or listening to people talk about data, you should come to the Ares conference in Bonita Springs. We're going to be presenting on April 7th, and love to have some people come out and take a listen to what we have to say.
And if you see some guy who looks like he's really deep in thought on the Barca Lounger as you're going through the airport, that would be Lonnie.
It's a good bet. And a couple more shout outs. Ginger R mentioned episode 129, and she actually said our comments on interest rate were easily digestible. So I hope that's also true of today. So we'll see how that goes. Carly Trepp and the team at Nuveen said they're big fans. And actually, if you watch us carefully in the next few weeks, we will probably have Carly on an upcoming podcast, which should be really good. BB, we talked about on Twitter, Scott B, who had a LinkedIn message of our office sector. And Lonnie, Professor Lonnie, you actually got a bunch of your students to give us some reviews. And I don't know if you had grades attached to those reviews, but they were some interesting comments.
I cannot confirm or deny if there were some incentives offered in exchange for some reviews, but I will say, I do think the class has been listening to the podcast, and just without the reviews to me personally have been positive, and they like the narrative that we're bringing news from the marketplace in real time to our listeners. And so the one thing about that's beneficial for me is if they give me a negative end of the semester review as far as my teaching performance, I'm going to have some podcast reviews to say, well, at least I'm pretty good on the podcast and our message is resonating. So shout out again to the Texas Tech students, and I appreciate them listening in and giving us some feedback.
Yeah, love that. And, we've talked about inflation. One area that I wanted to close us out with was ticket price inflation. The average price for Final Four tickets, for those of you that are NCAA basketball fans, in New Orleans was $286 when March Madness started. Now the starting going rate for a Duke UNC ticket starts at $1,000, and for courtside, it's about $32,000. You know what other tickets are up in the last week? That's right. Tickets to go see comedian Chris Rock are up 8 times. So that's all I'm going to say about that.
Well, we do have some really loyal listeners. We have Lewis, who's out there. He's a big Tar Heels fan. I hope he gets to go, and I hope he got his tickets long before the Final Four was determined last weekend. That rivalry is something else. It really, it's like the Yankees and the Red Sox and others that, price is no object when it comes to getting in the door and seeing some of those iconic games. I think down in Chapel Hill, or I should say down at Duke, the Cameron Indoor last month for the last game of Coach K's career at that arena, I think they said tickets were north of $4,000. So
ouch.
I hope you line them up early.
Yeah, when there's a comma in the ticket price, that means I'm not going.
You're out.
I'm out.
Well, with that, we'll close. Thank you, Matt Anderson, for joining us, and do look us up for that piece that he's written. Thanks to our producer, Haley Keene. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or comment, send an email to podcast@trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.